Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letter CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Hello, and thanks for joining me on today's episode of Reverse Mortgage Radio. Today, we are going back to basics. You ready for basic training? I went to basic training in 1983. It was a little different back then in the good old days. Never been to South Carolina before in my life. Went there in August. Never been east of Colorado. It was a little bit humid in August. It's at Fort Jackson, South Carolina. Luckily, you don't have to go there because we're going to talk about the basics of reverse mortgages on this show today. And I'm hoping we're probably going to have to do two shows, in all honesty. This is probably going to be a two-show topic. But we're going to dig our way through this at one question at a time. Obviously, the first question is, how do I contact you, Bruce, to find out more about reverse mortgages and get the process started? Well, that's an easy one. Again, my name is Bruce Simmons, and you can reach me directly at 303-467-7821. 303-467-7821. That's my direct line. It goes right to me. I've got it forwarded to a cell phone. So that number is not a cell phone. Don't text me at that number. It's a landline that I've got forwarded to my cell phone. You can also reach me online at reversemortgageradio.net. reversemortgageradio.net. And I will have this week's show up there usually by the middle of next week. The show is posted on my website. You can go back years and listen to old radio shows that I've had on my website at Reverse Mortgage Radio. You can download my free consumer guide, 40-some pages of good information. You can watch video testimonials. You can see all kinds of good stuff. You can get a free quote on my website. Fill out some basic information, and you'll get numbers right there. You don't have to wait for somebody to call you back or be afraid your name's going to get sold to 14 different lenders, anything like that. That does not happen on my website. All right. Now, for the second question, what is a reverse mortgage, right? Well, most of the time, a reverse mortgage is an FHA-insured loan that's specifically designed for people who are 62 and over. It allows you to convert a portion of the value of your home into money that you can use however you want. It's your money. At that point, you're borrowing it, okay? But just like any loan, when the lender loans you $10,000 on a personal loan, that's your money at that point. You have to pay it back, but it's your money. With a reverse mortgage, you don't necessarily have to pay it back right then. You're still charged interest, but no monthly payment is required out of your pocket. And that leads to another question, though. Well, who owns the house, right? If you're giving me a loan on my house, do I still own it? Yes, you do. And because it's still your house, you have to pay your property taxes and your homeowners insurance. You have to maintain the home. You have to live there as your primary residence. We only do this loan for primary residences. You cannot get this on a rental property. Ooh, that would be a sweet deal, though, wouldn't it? However, if you're a little more sophisticated, you could actually use money to put down on a down payment for a rental property, or even in some states, buy one outright, depending on the values in that state. But that's a topic for another day, and I'm not giving financial advice. I'm not suggesting you do anything like that. But it's still your house. You have to pay the taxes, pay the insurance, maintain it, keep your name on title, too. Your name has to stay in the title of the house because it's your house still, and you have to live there as your primary residence. As long as you do those things, you never, ever, ever are required to make a monthly principal or interest payment on this loan. So it's a fantastic deal. Okay. All right, let's go to, well, we kind of already started getting into that. How does a reverse mortgage work? And that leads to a second question that we're going to talk about too. I call it 2B. But how does a reverse mortgage work? All right. Basically, FHA sets up the rules. The FHA stands for Federal Housing Administration. This is an incredibly regulated loan. I mean, you'll know when you start shaking out your hand after you're signing the application and you realize you're only halfway through, right? Because you've signed 43 times or something already, and you're like, holy moly. But all this regulation is for your own protection. Now, it's really just meant to confuse you so you don't ask questions. No, that's not the case. I joke about this stuff because honestly, there are so many pages that you have to sign that it does become confusing. And then a confused mind doesn't remember anything. And that's what's so irritating about this, because we add 1, 2, or 3 forms every month, whether you need it or not. And most of the time you don't. I honestly think that you could probably get away with 8 to 12 signatures on this, but we have to have you sign every form for us, the lender. I have to have you sign all these forms at application. So if I ever get audited, the Consumer Finance Protection Bureau or FHA wants to audit me, I could say, oh yeah, actually they'll say, did you have them sign this authorization disclosure? Yep, right here. There it is. Well, did you have them sign the truth in lending? Right here. There it is. And then they go through all these forms, and then I'm like, oh my gosh, I missed one of 100 forms. And then they can slap a big old fine on my company. That's kind of the way our government works. Well, we'll see what happens going forward here. But there's a lot of paper, unfortunately. So in a nutshell, the way it works is we make this money available to you. You do not have to pay it, but you're still charged interest every month. Because it's also an FHA-insured loan, FHA has to get their piece because they actually provide some value. And believe it or not, they actually do. I think this is an excellent purpose for government, actually. And I'm not a big government fan. I think we could do with about 20% of the federal and state government that we have. But this is the way it is. But anyways, the way it works is you don't have to pay anything, but you're still charged interest. That interest has to go somewhere. It gets added to your loan balance. It's what's called negative amortization. The loan balance gets larger if you choose not to pay it. Now, you certainly can make payments on this loan if you want to. You can pay it off at any time. There's no prepayment penalty on this loan ever. On any reverse mortgage, there's no prepayment penalty on any kind of reverse mortgage that you could get, whether it's FHA insured or not. But what happens is you're still charged interest, and you are also charged mortgage insurance. The mortgage insurance goes into a big pool of money that FHA controls. They control this money, and then they will pay. They guarantee your loan. There's a couple of purposes for it. Number one, they guarantee that the money that you're due from this loan is going to be available to you. If a lender goes out of business, let's say you've got $100,000 left in a line of credit, or you're receiving a $1,000 payment every month, and the lender suddenly, poof, up and leaves. They're out of business. They lock their doors, or the government shuts them down, or they get hit by a tornado one month, whatever the case may be. They cannot pay you. The government will step in and they'll honor that commitment. They make sure you get your money. And it has happened in the past. Only one time in the 22 years that I've been in business have I seen it happen. Once. But the government was right there for you. However, they also protect the lender. That's right. The money you pay, well, the money you're charged, let's be specific. The money you're charged on this loan, because you don't have to pay anything, remember, actually protects the lender. And this indirectly protects you, your estate, and your heirs, because you're charged interest and mortgage insurance every month. Your loan balance gets bigger and bigger and bigger. In 2008, we had a little bit of a market correction in the real estate world. Property values dropped by 30, 40, and in some cases 50% of the value. Now, back then, we loaned a lot more money than we do now. We don't currently loan 60 or 70% of the value. We typically will loan 30, 35, 40%. If you're in your mid to late 80s, you could get 50% of the value, half the value of the home in the form of a reverse mortgage money. But what happens is it's still possible that you could end up upside down in this loan. In other words, you owe more on the house than it's actually worth. If you live there for 25 years, the loan balance grows over time. The interest compounds on this. So your loan balance will grow and grow and grow as long as you don't make any payments on it. If the value of your home were to come down, even though we're only loaning you, say, 35% of the value to start with, let's say 25 years from now, your $200,000 you took out now has on your $600,000 home now has dropped. Your $200,000 loan balance has grown to $800,000. Your $600,000 home, maybe it was worth $1.2 million at one time, but boom, suddenly it drops down to $600,000. Well, you owe $800,000, so you're $200,000 upside down. If that happens, it doesn't matter. Yeah, I said it. It does not matter because you are never responsible to pay it back. You can continue to live there as long as you pay your taxes and insurance and all those other things that I talked about. But the lender can never come after you. But then you pass away. Your kids inherit a home. They talk to a real estate agent. Oh, wow, mom's house is only worth $600,000. Then we look at this statement. Holy moly, she owes $800,000 on this loan. We're $200,000 in debt on this house that we can't pay. No, they're not. They are not responsible for it. It's called non-recourse. All reverse mortgages, whether they're FHA insured or not, are non-recourse. The non-FHA insured loans charge a much higher interest rate, so that's how they kind of cover their rear end for the non-recourse aspect of it. But with FHA loans, they're right now, I think the interest rates on FHA loans are either at or lower than a traditional mortgage. Because I don't pay attention to normal mortgage loans. I just know what's going on with the reverse world. But it's a very competitive rate, okay? And but interest still accumulates. And it's possible that you could end up owing more on the house than it's worth. But what happens is the heirs are not responsible. They can either sell the house or they can either sign the house over to the lender and walk away. The lender will then sell the house for whatever they could get for it, and they file a claim with the mortgage insurance company that is FHA. FHA will pay the lender. Yeah, they pay the lender their loss. So they're not losing anything because they're made whole. Because the lender does not lose anything, they're not going to come after you, your estate, or your heirs for any loss. However, if your adult kids want to keep the house, they can. They could keep it and they just pay 95% of whatever the value is. In that scenario, the value is $600,000, $800,000 is owed on it, but they can go get a new loan for 95% of the $600,000 value. The lender has to accept that money, and then they'll file a claim with a mortgage insurance company to get the difference. But then your heirs can still keep the house, even when you're upside down, without them having to pay the difference. If you just tuned in, you are listening to Reverse Mortgage Radio. My name is Bruce Simmons. I'm the Reverse Mortgage Manager for American Liberty Mortgage here in Denver. You can reach me directly at 303-467-7821. 303-467-7821. That's my direct line. You can also visit me online at reversemortgageradio.net. reversemortgageradio.net. It's a very expensive website. Hopefully you like it. I pay a lot of money every month for that. But we probably have gone through, even though technically it was only 2 questions, I think I touched on about 6 or 7 there. But a side question about how do reverse mortgages work, they talk about, I've had this question, in fact, just this week, I had a question, why am I having to pay interest when I'm borrowing my own money? You figure it's your equity, you're borrowing your own equity, so why are you charged interest? Well, number one, you're only charged interest. You're not paying interest. Okay, you're like, well, what difference does it make, Bruce? I'm still having to be charged interest on my own money. Well, no, it's not your money. It's your equity, but that equity is only used as collateral, just like any other loan. If you get a car loan, or let's say you go to the bank and you own your car free and clear. You have a brand new Tesla. You paid cash for it, but now you're a little cash strapped. So you tell the bank, hey, I want $50,000. I'm borrowing $50,000. I'll use my Tesla for collateral. What do you think? Yeah, you think they're going to give that money to you with no interest? A zero interest loan? No, they're going to charge you interest. But it's your money. It's your car. No, it's not your money. You're borrowing someone else's money. Just like a traditional home equity line of credit. If you went to your bank and you said, I want a HELOC, do you ever question the bank and say, well, why am I being charged interest on my own money? No, you're borrowing the bank's money, and they're using your house as collateral. So if you don't pay it, they're going to take your house. Just like with a reverse mortgage. If you didn't keep up on all those rules, you didn't pay your taxes or insurance, the lender, that means you're not following the rules and you're defaulting on your obligation to pay your taxes and insurance on your house, the lender's going to foreclose on you, okay, eventually. So you've got to make sure you follow those rules because the house is security. Also, too, even you can't even borrow money from your own 401k without being charged interest. Isn't that crazy? Yeah, there you really are borrowing your own money, but it's money that the 401k plan is not earning interest on or whatever. I don't know how all that works. But that's another question. All right, let's go to a couple of the ones that a lot of people will ask me first and foremost, because a lot of people think they understand how a reverse mortgage works. So they jump right into the questions that they would ask on a regular loan. Well, how much can I get? And what's the interest rate? Let's deal with those one at a time real quick here. How much can someone receive from a reverse mortgage? Well, I kind of hinted at it already. Remember I said somewhere between 30 and 50% typically. But it's based on three factors. And the lender does not choose how much you can receive. It's not like the lender has any say in this. There's a formula that FHA devises. It's called the principal limit. That's the loan amount. What we call the loan amount is called principal limit. And basically there's a table that takes into effect the age of the youngest homeowner, the value of the home, and the interest rates. So the age of the youngest homeowner, let's say you're 75 and your spouse is 70 years old. We're going to base it on your spouse's age because the younger spouse is most likely going to live in that home longer than you. The younger you are, the less money you qualify for. So if you're 62, you're going to get a lot less money than somebody that's 92 or 82. Just because somebody who's 92, odds are they're not going to live in the house for very much longer. They might live there another 6 or 7 years, 8 years if they make it to 100. If you're 62, it's very easy for you to possibly live in that house for another 20 or 30 years. So the interest has more time to accumulate on the loan. So we compensate for that because as interest accumulates on the loan, your loan balance gets bigger and bigger and bigger. If we loaned you 70% of the value when you're 62 years old, the odds are very, very good with compounding interest that you're going to end up owing more on the house than it's worth in 10 years or 20 years down the road. That's why we compensate for that. And the younger you are, the longer we expect that interest to accrue, so we're going to make less money available to you at the beginning. Also, the higher the interest rate is, the less money we're going to loan you. Because figure, if the interest rate is 7% compared to, say, 4%, which one is going to grow at a faster pace? If you're at 7, let's just use 7.2% because there's something called the rule of 72. Basically, every 10 years, the money that you owe is going to double. It's going to double again 10 years from now. So if you take out $200,000 at 62, at age 72, based on the 7.2% interest, you're going to owe $400,000. At 82, it's going to become $800,000. So it compounds. Now that we don't know what the interest rate does. It might come down. It might go up. You may make payments on it. You may tap into additional money that's available through your line of credit. There's a lot of moving parts to this. Your house may double, triple, quadruple in that time period too, and there's no problems with that because now your house, you might owe $800,000 on the loan, but your house is worth $1.5 million. So we just don't know. But the higher the interest rate and the younger you are, the less money you qualify for as a percentage of the value of the home. That's why somebody that's 62, given the rates today in this low to mid sixes, we're only going to be able to give you about 30, 32, 34% of the value. Now, back in 2021, when rates were 2%, we were offering people 50% if they were in their early 60s. And then if they were in their 70s, we were offering closer to 57, 58, 60%. People in their 80s got 65%, almost 70% the older they went. But now, because interest rates are higher, you get a lot less money. So there's a lot of moving parts in how much money you can get. And keep that in mind. The older you are, the more you can qualify for. The lower the interest rate, the more you qualify for. All right? Yeah, and another one that people ask a lot of times too is, how do I get the money? Like, how can I take it? Well, first of all, we have to pay off any existing loan on your home. This is where we run into problems now because people will call me and they misunderstand when I say we can loan 30 or 40% of the value. They hear 30 or 40% of the equity. The equity in the home is where you take the value of the home and you subtract the amount owed. If you have $1 million home and you owe $400,000 on it, then you have $600,000 in equity. They'll call me and they'll say, how much can I borrow on my equity? And I'll say, well, how much do you owe on the house? They say $400,000 and it's worth $1 million and I'm 62. And I say, well, I can only loan 30% or say 32% of the value. That's only $320,000. They're like, okay, great. So I'll take the $320,000 and then I'll owe $720,000. The $400,000 on my first and the $320,000 on the reverse. No, that's not how it works, unfortunately. I wish it were. Gosh, I wish it was that way. But what happens is we have to pay off any existing loans on the home. We can only loan you $320,000 in this scenario. You owe $400,000 on the house. That means if you want to do the reverse mortgage, you have to bring $80,000 to closing. So we take the $320,000 that we loan you. Now I'm not factoring in any closing costs or anything here, but we take the $320,000 we can loan you, and then you have to pay $80,000, and that equals $400,000, and then we could send that to your current mortgage, and now you don't have a mortgage payment. So if your principal and interest payment on that mortgage was $2,000, now you're saving $2,000 a month. But you're like, wait a minute, how much am I going to get then? Well, you're not getting anything because you're paying $80,000. It's kind of a weird concept for people to understand sometimes, but we have to be able to loan you enough to pay off any existing mortgage first. That's where it comes in. Let's say we can loan you $320,000 and you only owe $200,000. In that situation, then we take the first $200,000 and pay off the mortgage that's owed, and that leaves you with $120,000 left over. So that you can tap into, and you could take money that's left over, or if you own your home free and clear, let's say, whatever money is left over after paying off your mortgages can be taken any one of 4 ways from a reverse mortgage. You could take it as a lump sum. Now there's restrictions on the amount of money you could take in one lump sum in the first 12 months of the loan. Call me for details, okay? That's the easiest way to say it. You can also set up a line of credit where you just leave that money. Let's say you've got $120 left over. You don't need it. Don't take money out from a reverse mortgage if you don't need it. okay? Because you're still charged interest, remember? You don't want to be charged interest on money that you can't earn more on. And you don't want to put this money at risk. Don't take money out of a reverse mortgage and invest it. I'm not providing financial advice, but that's just the way I see it, and FHA frowns on that too. But then, so you could leave it in a line of credit. There's a ton of benefits to the line of credit. That's a show in and of itself, all the benefits of having money in a line of credit, because the line of credit will actually grow over time, meaning you can access more money a year, 2 years, 10 years down the road if you don't touch that money than you can today. You can also receive money on a monthly basis where we deposit money every month in your bank account. That's that old saying, and you may have heard it, you may not have, where people say, well, a reverse mortgage is where the bank pays you instead of you paying the bank. Yeah, that's one way. The bank pays you every month, or the lender, in this case, will pay you every month, but you're just receiving money out of your own equity. Now, you're being charged on whatever money you take out. If you're pulling out $1,000 a month, your loan balance grows by $1,000 a month, plus the interest that you're charged that month. Keep that in mind. So if you don't need it, again, don't take it. I always say, if we're eliminating a mortgage payment, how can you afford to live comfortably? That means having a little bit of money extra for going out to lunch with your friends, or golfing once a week with your buddies, whatever the case may be. Having that extra money. So those are the three different ways, but I said there's four. So you could take money as a lump sum. You could take it as a line of credit. You can set up a monthly payment, or you could do a combination of all of the above. If you own your home free and clear, you've got all kinds of flexibility. You could probably, let's say you got $320,000 available. You can take out $50,000, say for some home improvements, and maybe we pay you $1,000 a month in a monthly stipend, and you might still have $100,000 left over that you can save for emergencies and let grow over time. There's a lot of different ways that you can do it, and you can change the payment plans down the road. That's what's one of the beauties of this program. This is the most flexible loan I've ever seen, and I've been in the lending business since 1987. When I was 21 years old, I started in this business. I turned 22 that year, so you can do the math and figure out how old I am today. I was born in 1965, but I started at 21 in the lending business, and this is the most flexible loan. Well, we got through like 3.5 questions here. I touched on probably 10. I've got another 10 or 12 or 15 questions to go. We're going to have to continue this next week. Please make sure you tune in. In the meantime, feel free to call me with any questions. My name is Bruce Simmons. My number is 303-467-7821. 303-467-7821 is my direct line. And you can also visit me online at reversemortgageradio.net. Go there, download my free consumer guide. Listen to the podcast. If you just tuned in and now I'm leaving, you're like, oh, Bruce, where are you going? I'm not going anywhere. I'm going to be online. This show will be there the middle of next week on reversemortgageradio.net. Hope you have a great day, and thank you for joining me.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821 or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.